All right, quick favor before you scroll. If you care about markets, stay with me for the next few minutes, because what just happened in silver isn't normal. We just watched silver drop from 120 to 99 in a blink. $21 gone, fast enough to make seasoned traders check their feeds twice. And here's the thing. The real trigger isn't what most headlines are screaming. This wasn't about physical demand evaporating overnight. This was positioning stress colliding with a surging dollar. And it matters right now because this exact pattern shows up before much bigger shifts. I'm going to walk you through what actually happened, how to recognize it next time, and why this move is bigger than just silver. If you're holding positions right now, you need to understand what just hit the tape. If you're watching from the sidelines, you're about to learn how to spot the next one before it happens. Now, before I explain what caused this, let me teach you something most people never really internalize about markets. Price doesn't move on opinions. It moves on positioning. It moves on leverage. And it moves on how crowded a trade has become. Think of a market like a packed theater. Everything's fine while people walk calmly to their seats. But once someone yells fire, it doesn't matter if there's smoke or not. The exits get jammed. That's what happens after Parabolic runs. The move up feels strong, confident, unstoppable. But underneath, leverage quietly piles up and risk tolerance thins out. So when the market flinches, it doesn't step back. It stumbles. And that stumble turns into a sprint for the exit. When you see price go vertical like silver did, you're not watching strength build. You're watching fragility compound. Every new buyer at elevated levels is using margin. Every position gets more sensitive to shocks. And the whole structure becomes like a Jenga tower. Looks solid until someone pulls the wrong piece. If this is making sense, drop a comment and let me know you're following along. So what does that tell us? It tells us that the setup for this drop was built during the rally, not during the fall. The fall was just the release. Here's what you need to know about silver's run to 120. That level wasn't just psychological, it was structural. It was a magnet for profit-taking, stops, and margin sensitivity. Most people don't understand that when price goes vertical, it's not strength. It's fragility dressed up as confidence. And when you pair that with a sudden dollar spike and rising yields, you've basically lit a match in a room full of paper positions. Let me walk you through what actually happened, step by step, because the sequence matters. First, the US dollar caught a bid. Not slowly, decisively. The dollar index pushed higher on renewed flight to safety flows and shifting expectations around rate policy. That alone tightens financial conditions, especially for dollar-priced commodities. When the dollar strengthens, it makes commodities more expensive in other currencies. Demand gets pressure. But more importantly, it affects the carry cost of leveraged positions. Traders holding futures contracts suddenly face higher funding costs. That's the first crack in the foundation. Then yields pushed higher, not dramatically, but enough. When treasury yields rise, the opportunity cost of holding non-yielding assets like silver increases, and if you're leveraged, that cost compounds. You're paying to hold a position that's now competing with safer returns elsewhere. That's the primary trigger. Not a conspiracy, not manipulation, just math. Then came the secondary confirmation. Silver failed to hold 120. Once that level cracked, stops started firing automatically. Not opinions, not emotions. Code, algorithms, risk systems. Large institutional desks have automated stop-loss orders built into their risk models. When price breaks a key level, those orders execute whether anyone's at the desk or not. So when that trigger hit, the selling fed on itself. You had momentum traders who bought the breakout suddenly underwater. You had long-term holders seeing their gains evaporate and deciding to lock in profits. You had leveraged longs getting margin calls from their brokers. All of that happened at once. And here's what makes it worse. When selling volume spikes like that, market makers widen spreads to protect themselves. So the bid-ask gap grows, liquidity gets choppy, and anyone trying to exit finds fewer buyers at reasonable prices. That's when an orderly pullback turns into a cascade. Here's what's wild about this. Liquidity didn't disappear because nobody wanted silver. Liquidity disappeared because too many people wanted out at the same time. Large paper positions started unwinding in a narrow window. Margin calls forced hands. That's when you see those vertical red candles on the chart. It's not natural selling, it's forced liquidation. And here's the part that should make you nervous if you don't understand it. Momentum doesn't flip gradually in these moments. It snaps. 1 minute you're buying dips because you believe in the trend. The next minute you're just trying to survive the tape. That's what forced selling looks like in real time. It's violent, it's fast, and it doesn't wait for you to figure out what's happening. Now let me zoom out because this isn't new. This is the exact same playbook we saw in silver in 2011 after the parabolic spike near 50. Back then, silver ran from 20 to almost 50 in a matter of months. The move felt unstoppable. Every dip got bought, and then it cracked. When it broke, it didn't trickle down, it collapsed. Silver fell back to 33 within days. Why? Same reasons. Leverage was extreme. Margin requirements got raised. The dollar caught a bid, and forced liquidation took over. The fundamental case for silver didn't disappear overnight, but the positioning became unsustainable. It's the same pattern we saw in gold during the 2020 blow-off when dollar funding stress hit. Gold ran to 2070 in August 2020, then reversed hard when the dollar rallied on safe haven flows and real yields adjusted. Again, it wasn't that gold's macro story fell apart. It was that the trade got too crowded, leverage was too high, and conditions shifted just enough to trigger unwinding. And you can even see echoes of it in broader markets during the 2018 volatility shock. Remember when the VIX spiked and equity markets gapped down? That wasn't a recession. That was a deleveraging event. Short volatility positions unwound violently. Margin calls hit. Algorithms kicked in. Same mechanics, different asset. Every time this has happened, the common thread wasn't collapsing fundamentals. It was leverage meeting tightening conditions. When you look at the pattern, extreme rallies followed by dollar strength and yield pressure don't end softly. They reset, sometimes violently. The larger story is this. Markets punish crowding long before they punish bad ideas. You can be right about the long-term thesis and still get crushed if you're wrong about timing and positioning. That's the lesson history keeps teaching. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could big players be smashing paper silver to scare retail out and accumulate at lower prices? Let me be honest, markets can be ugly and incentives aren't always aligned with fairness. But you don't need a conspiracy to explain a forced liquidation cascade. When levels break and leverage is high, selling happens automatically. The more productive question isn't who did this, it's what conditions made this possible. Because if you focus on shadowy motives, you miss the actionable signal. You can't control what big players do. You can control how you manage risk, where you set stops, and how much leverage you use. Could yields reverse tomorrow and silver bounce back? Yes. Could the dollar weaken and restart the rally? Absolutely. But that doesn't change what just happened. Focus on what you can control: structure, positioning, and risk. There are probably 3 types of people watching this right now. First, there's the long-term silver bull. You believe in the macro story. You believe in supply constraints, in monetary debasement, in silver's role in the energy transition. That's fair. I respect that thesis. For you, this move hurts emotionally, but it doesn't invalidate the long-term case. Your job right now is to separate price damage from thesis damage and avoid overreacting. If your time frame is years, not weeks, this is noise. But you still need to ask yourself, was I overleveraged? Did I chase the top? Did I have a plan for volatility? If the answer is no, use this as tuition. Don't double down on hope. Reassess your risk and make sure your position size matches your conviction and your time frame. Second, there's the trader who got caught chasing momentum. Maybe you bought silver at 115 because it looked unstoppable. Maybe you added to positions near the highs because you didn't want to miss out. If that's you, no shame. This is how tuition gets paid in markets. Everyone who's been around long enough has a story like this. The lesson is simple. Vertical moves demand tighter risk controls, not looser ones. When something's going parabolic, that's when you should be most cautious, not most aggressive. Respect the setup, respect the structure, and always know your exit before you enter. Third, there's the observer, sitting in cash, trying to learn. You didn't get hurt this time. You're watching and asking questions. You're actually in the best position. Watch how price behaves now. Does silver stabilize and build a base, or does it continue breaking down? Watch volume. Does it dry up after the flush, or does selling persist? Watch volatility. Does it compress, suggesting the move is exhausted, or does it stay elevated? These are the lessons you can't learn from reading. You have to watch them play out in real time. The universal principle for everyone, no matter which camp you're in, respect leverage, always. Leverage amplifies gains, but it also amplifies pain. And in moments like this, it's the difference between a manageable pullback and a catastrophic loss. So here's where I stand. I'm not panicking, and I'm not blindly buying either. I'm patient. Let me tell you what I'm personally watching. First, I'm watching whether silver stabilizes above prior consolidation zones, somewhere in the mid-90s to low 100s. If it holds there and starts building a base with decreasing volatility, that tells me forced selling has burned out, and we might see accumulation. If it breaks lower, that's a different signal. It means the damage was deeper than just a technical flush. Second, I'm watching the dollar. Does this strength persist, or does it fade? If the dollar rolls over and starts weakening again, that removes one of the primary headwinds for commodities. But if it continues strengthening, especially on safe haven flows or shifting rate expectations. That keeps pressure on silver and other dollar-priced assets. Third, I'm monitoring yields. If Treasury yields keep climbing, that's a sustained headwind. But if they plateau or reverse, that changes the equation. The interplay between the dollar and yields is critical right now because those are the conditions that triggered this move. Based on my analysis, this move was mechanical, not emotional. It was technical, not fundamental. The underlying reasons people own silver didn't vanish overnight. Supply fundamentals haven't changed. Industrial demand hasn't collapsed. Monetary concerns haven't disappeared. The move we just saw was about positioning, leverage, and technical levels breaking in a tight liquidity environment. If history rhymes and silver stabilizes here, the move that follows could be significant because you'll have cleared out weak hands, reset sentiment, and created a cleaner technical setup. But that's a big if. Markets don't owe us bounces just because we want them. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Make your own decisions based on your own risk tolerance and time frame. What I'm giving you here is a framework, not a forecast. I'm showing you how to think about what happened, not telling you what to do next. If you made it this far, you're thinking critically. That mentality will serve you well. Most people react. You're analyzing. Most people panic or chase. You're building a framework. That's the edge. Share this if it helped. Subscribe if you want more breakdowns like this. And stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.